Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. Have you been thinking about selling your minerals or royalties but are not sure where to start? If so, then you're in luck because that's exactly what today's episode is about. Before we get started, just a reminder that you can find the show notes at mineralrightspodcast.com/episode 70. And there you'll find the link to download my free cheat sheet with the important details behind the 5 key steps that we're going to talk about today. This cheat sheet has the key things you need to know in order to sell your property for top dollar. And I have a quick introduction before we get started. Justin Williams joins me again to provide the individual mineral owner perspective. Hi, Justin.
Good morning, Matt. Thanks for having me.
Thanks for coming on the show. And today we're going to talk about 5 tips if you're thinking about selling your minerals or royalties. This will give you a complete roadmap of all the things that you need to consider before pulling the trigger and actually going through the process of selling. So this will identify the information that you need to make an informed decision as to whether or not it makes sense for you to sell some or all of your property given the market today. And the reason we're going to talk about this is because I've gotten a lot of feedback from listeners. This is one of the most sought after topics where people are looking for more information. And so what we're going to do today is dive deep into the 5 key steps that you should follow on the process of selling your property. And this is the prequel to episode 5 of the Mineral Rights Podcast, where we talk about the typical sales process that you go through once you've decided to sell and what are the steps, who's responsible for what between buyer, seller, and then 5 key red flags to look out for. So if you haven't listened to that episode yet, go back and listen to episode 5. It'll provide some more detail as to the actual steps that you go through once you've signed that purchase and sale agreement with the buyer. So today, again, we're going to talk about the stuff leading up to that, the deep dive into all the things you need to do. And again, this is just a disclaimer here. You definitely need to seek the advice of someone from a tax point of view and then also from a legal point of view to help you review any documents before you sign them. So if you do decide to sell, and we'll talk about potential costs for each of these steps and who you should contact if you need help. And so we'll dive into that as well. But just know that your specific situation will dictate whether or not it makes sense for you to sell and or what your target is for that sale. And so this is really just providing the information that you need to make an informed decision as to whether or not you should sell if you are so inclined. If you need to raise money today for a specific life event that's happened, maybe it's a loss of job, health issues, maybe you want to send your kids to college and you need to raise some money to help for that tuition. And so this is really the what you do or how you go about evaluating that. We're not here to give you financial advice or legal advice, but just to help guide you through the things you should think about and provide this from an educational point of view. So, Justin, let's go ahead and dive into the first step in the process.
All right, let's do it. So step 1 is to know what you own. So organize your documents, such as mineral deeds, which identifies the property you own, the legal description and any reservations. Identify the royalty rate, other lease terms for any PUD acreage. This will be needed by potential buyers to develop the value of undeveloped acreage. Division orders, which prove your NRI. Check stubs, which prove your royalty income over the past 3 to 4 months. And then also be prepared for possible costs with a landman or an attorney through this process to really clearly identify the chain of title.
Yeah, and the thing that, like Justin mentioned, that PUD acreage, what that refers to is proved undeveloped. And so what that basically is any acreage that you have that doesn't have wells on it that has space for additional wells, whether those are vertical wells or horizontal wells. And so that's where an operator may come in the future and drill out that acreage. And so it'd be future royalty payments that you would be entitled to at that point. So there's some value that goes along with PUD acreage when you sell your property, especially if it's in a shale basin and if you're in the core of an area within the shale basin where there's still good activity, there's still good geology, then that will demand a higher price than maybe if you're on the fringes where maybe that PUD acreage is not going to demand as high of a price. So those are things that you need to understand. And especially, like Justin said, you have your oil and gas lease, and that's important because the royalty rate that you agreed to in that oil and gas lease will be used in the valuation process by any potential buyer to place a value on that PUD acreage or that undeveloped acreage. So that's where we go back and we've talked about negotiating an oil and gas lease and why it's so important to get a good royalty rate as really kind of the key in setting the value for your property. Because at the end of the day, just an example, if you have a lease that is at a 25% royalty rate versus a 12.5% royalty rate, basically that 25% royalty rate is going to get you twice as much money for your property than if you had agreed to a 1/8 royalty or that 12.5% royalty. So royalty is key. Other clauses are important. You can go back and listen to our episode on negotiating an oil and gas lease to find out more. But that's just a little bit of background as to some of the acronyms we're using here. The other thing is division order, that NRI. That term means net revenue interest. And basically, that's the decimal interest that's shown on your check stub. And so, again, all these documents are important to have organized on an ongoing basis, but then especially when you go to sell, because these are the documents that you will provide to any potential buyer to give them the information they need to perform a valuation and to give you top dollar. If they have to make assumptions, they're going to make assumptions that are going to be in their favor. So, to the extent that you can give them as much information as possible, knowing what you own is probably one of the most important steps, both from a ongoing minerals management point of view, but then also if you're looking to sell. And so that ties into the next step, which is step number 2, which is to know what your property is worth. And for this, there are a couple different ways you can go about this. The first step or the first way of potentially determining the value of your property is to hire a consultant or an engineer to perform a valuation. And the cost for this generally will range in the $600 to $800 per property. Again, if they're far apart, you could expect to pay that per property. If you have a bunch of acreage that's close together, they may be able to combine some of that work in the valuation and give you kind of a little bit lower price per property. But in general, I would say $600 to $800 to have this done for you. And if you have a good, thorough valuation, what you would expect to receive is not just the value in a lump sum payment today if you were to sell your property, but to tell you all the assumptions that went into that valuation, such as what is the commodity price outlook for both oil and natural gas? What are timing assumptions around any new drilling activity on your acreage? Again, going back to those PUD wells and that undeveloped acreage, when are those new wells expected to come online or to be drilled? Because that will determine when you would start to receive those future royalty payments. And all of that would be factored in as well as any existing royalties and discounted back to today to give you a lump sum value. If the wells are going to be drilled next year versus 2 to 3 or 4 years from now, that can have a material difference on the value of the property. So knowing that and understanding why they are modeling any new wells a certain way in terms of timing is important, because that'll help educate you and inform you when you go into the negotiation with a potential buyer. Because on the other end of the phone or other end of the email, they're doing the same thing. They're looking at what they think is going to happen to your property in terms of when any new wells might be drilled, if ever, if it's got extra space for that. If it's already fully developed, you already have royalties coming in from existing wells, then they're going to value the property on what's called a PDP basis, which is proved developed producing. And that's just the reserves category for those wells, means that they're producing wells. Any existing royalties will be discounted back to today to give you a lump sum value. So they'll look at all those wells you're receiving royalty payments for, and look into the future, do a forecast for those wells, figure out what they think those future royalty payments are going to amount to on a monthly basis, and then bring that all back to today from a time value of money point of view, give you a net present value at a certain discount rate and say, here's what we think this property's worth. This is what we're willing to buy it for. And so when you hire a consultant to do this for you, you're getting the same information that the buyer is using on their end to evaluate your property and to figure out what your property is worth. And so you can be armed with the same information and be on a level playing field with them from an information point of view if you do have that valuation. That, again, if it's a good valuation, and when I do a valuation for a potential client, I provide a map of their property showing where offset wells or existing wells on their property, the boundary of that property or that section or quarter section or whatever the area is, and then showing any permits that are there, any pending permits, where rigs might be located, who's the operator, maybe if they don't have existing wells, but they have leased it, who's the current operator, who's the one that's out there filing pooling orders or spacing orders, and showing that regulatory information as well, so that you have the complete picture as to what activity level is, assumptions on pricing, and then what the assumptions are on when a well is going to be drilled based on available information. And so, again, that is step number 2, knowing what your property is worth. You'll get from that process a lump sum amount to tell you your property is worth X dollars. And then if you have completed a title search, or if there's enough information around how many net mineral acres you own, then you can use that, and the consultant should be able to provide a dollars per net mineral acre basis or dollars per net royalty acre basis to give a couple of metrics that you can use. Because a lot of times when you get offers from potential buyers, they will give you a dollar per net mineral acre as an offer. So maybe $3,000 per net mineral acre, and then they'll have the terms and conditions of the offer and so forth. And so, again, knowing what your property is key, because that gives you an idea of reasonable price to expect, and also a target for your negotiation. So you have a value that you want to land on for what you receive for that, instead of just shooting in the dark and just hoping for the best offer to just come in from the first person that you talk to. So that's an important piece. So, and that ties in, like we mentioned, a consultant will do the detailed groundwork for you, but knowing what's going on is important. So, Justin, you want to talk about that? And if you were to do it yourself, what are the things you need to look at?
Absolutely. So knowing what's going on, nearby activity is critical. Permitted wells, pending permits, pooling and spacing orders with the State Oil and Gas Commission, wells recently drilled or completed. You can utilize free platforms like Well Database, mineralanswers.com, and some of those may have monthly subscription costs that come along with those. However, I will say that I have had Matt perform an evaluation on my property, and it is just hugely insightful, not only for creating that offer to go off of, but also just for informational purposes. So I think that's something that's commonly overlooked, but really hugely helpful. So again, to look for yourself, you want to look at any of the activity going on. And then the next step, which I think is one also that's not talked about a lot, Matt, is understanding your options. And the plus and minuses of all of these, maybe different forms of selling your minerals, taking a loan against your minerals. You want to talk about that a bit, Matt?
Sure. I'll take a stab at that. And before we move on to that next step, just to also say that a lot of state oil and gas commissions have really good websites with map interfaces, or you can pull production data. So that's always a good place to go. And that's usually free. There's some states that I think charge for, depending on what information you can get access to, but most of them are free. Again, there are free platforms out there. You can go to mineralrightspodcast.com and go to the resources page. We'll have links to Well Database where you can find out more. They have a free plan where you can go and research production data on individual wells and look at your property and see what activity is going on. That's a great spot to go check that out. And it's a lot easier to use than most state oil and gas commission websites. Also mineralanswers.com, similar type of format, map interface, and you can sign up for email alerts for permits and nearby activity to your properties. And again, talking about possible costs for this, there is a monthly subscription that you can pay for a version of Well Database to get access to well forecasting and some of the analytics. And so I have a YouTube video where I walk you through how to forecast production on your wells and so that you can estimate future royalty payments. So I walk through that step by step using Well Database on how to do that. And you just need the next step up from their free plan in order to be able to do that. You can find out more again going to our resource page and check that out. And so that consultant is valuable from the standpoint of finding somebody in a particular basin that's knowledgeable about also what minerals are transacting at in the current market, knowing what future value of that property is, and then marrying those two together to give you a value is really a pretty inexpensive thing to get done for you, $600 to $800. If you do it by yourself, again, you can get a Well Database subscription, $250 for 1 month. There's no contract. You can just sign up for the 1 month, forecast your stuff, and then do the calculations on your own to discount that back to the present day. Definitely, if you don't know what you're doing, then it's difficult to know if the answer that you get is reasonable or not. So that is the only caveat there. But both options are definitely out there. People that like to get into the nitty gritty, you can do some of this you're on your own. And so that's something to think about. But like you mentioned, Justin, there are definitely multiple options to consider if you're going to go and sell. And knowing this can give you some different things to play around with as to how much you want to sell. So once you have a number as to what your property's worth, and if you have a specific financial target as to how much you want to raise right now, maybe your property comes in with a valuation of $200,000. You need $50,000, or you want to spend $50,000 on something for some life event or some expense that you have. Well, you don't have to sell your entire property. You could sell, in that scenario that I just mentioned, a quarter of your interest, get that $50,000, but then keep the remaining three quarters of your interest value of $150,000. So any sort of range within that, you can sell all. Again, that's 100% all right title and interest. You're done. No more minerals. Or you can sell some and only give up a small portion of that just to raise the money that you need today. The thing that I'll also mention, that you can get a loan against any existing royalties. So this is one option, especially if you have fully developed property and you're looking at wanting to get some money now, but you don't want to give up the future upside of those. You can just get a loan against those existing royalties, not sell them, but then again, that's something you'd have to pay back. So that's something where you'd have to be prepared to make those monthly payments so that doesn't get foreclosed on. You don't lose the property. So something to think about. All these options are things you would need to talk with a financial advisor about. The other thing is, if you sell just the non-participating royalty interest. So if you have the desire to maintain the executive rights, so in other words, the right to negotiate an oil and gas lease on your property, but you want to sell a royalty, you want to sell a non-participating royalty, that's a way to do that. And so there's more information about what an NPRI is. We have one of our first episodes, we talk about difference between minerals and royalties. You can go to mineralrightspodcast.com and look that up and find out what an MPRI is and when it might be useful. But that's another potential option. The other thing to think about is if you have some existing wells on your property, but there is room for future wells to be drilled. One thing you can do is sell a wellbore only interest in any existing wells while keeping your mineral rights for that future upside potential. So that is a nice combination for being able to generate money today. And you have, again, those PDP, proved developed producing wells. and the wellbore interest in those wells can be sold. So you're basically giving up your interest in those wells that you signed the division order for. So the wells that showed up on that division order and that show up on your check stubs, you can sell that. And that actually is in hot demand right now. There are mineral buyers out there right now that are very much focused on any existing production because it's easier for them to put a value on those properties by coming up with whatever price deck they have as to future commodity prices. And they can put those assumptions against those well forecasts, which those are, again, pretty straightforward to model out. And they can come up with a number that you can generally agree upon. And the thing with producing wells is it demands a lower discount rate, which means a higher value. So when we talk about time value of money, you discount those future payments back to today at some future rate. And so if you have a discount rate of perhaps 8 or 9% or 10% for any existing production versus a buyer, especially in today's market, is probably going to want to discount any PUD acreage at a 30 or 40 or 50% discount rate in order for them to manage the risk with that future production coming online, because there's just really a lot of uncertainty right now as to when operators are going to go back and start drilling acreage. And so if there's a lot of uncertainty, what that means is a lower price for you if you're looking at selling today. So one way to get top dollar, selling only the wellbore only interest in existing wells, generating cash to meet whatever needs you have, but then holding on to your minerals for that future upside potential. And again, when we talk about cost for all these different options, these are just some possible scenarios. Again, you'd have to really talk with your financial advisor, identify how much you want to raise, and then you can look at, once you know the value of your property, how these different options might fit into that. And again, you can work with a consultant to help model just the existing production versus the new production and see how much that would get you. And then, use that to help inform the decision. So potential costs for this step, it could be with an attorney in drafting any documents. If you do decide that you want to go forward with maybe selling just the wellbore only interest, you'd want to have an attorney draft that up in the actual instrument that you used for that transaction, so that it specifies exactly what's being sold and only that, so that you're not giving up your full minerals. And so that's the one thing to think about, understanding your options. Again, once you decide what it is, then the ways you can market your property, or the how, is using things like an online auction like EnergyNet. You can use that advisor or consultant to help market your property if they provide a turnkey service to do the valuation and then help market, get multiple bids to help you decide, and then help walk you through the sales process. And then if you do it yourself, the DIY route, the ways that you'd market it is you'd want to identify the top buyers in the county where you own minerals, search the county records to see who's buying, search companies on Google, see what people are saying on Mineral Rights Forum about those companies. And so, once you have that due diligence done, basically to identify who's buying, who are the reputable buyers, who are the end buyers, because you're going to want to look at in those county records, while somebody may be buying from an individual mineral owner, you look at their history and you see that they might be flipping that property to an end buyer right away. So you look at the deeds that are recorded for that particular grantee, is the way that it'll show up in the actual instrument. If you're the grantor, you're the one selling. The grantee is the person buying. They're showing up as a grantee, and then you search their name again, and they show up as a grantor with that same legal description. Well, that means they're flipping that property to somebody else, and you'd want to try to go to an end buyer because they're potentially going to be willing to give you a little bit more money. Again, especially if you have a larger interest, a larger number of net mineral acres, that will demand a slightly higher amount of money because they're having to do the same amount of work whether you have 10 mineral acres or 100. And obviously, the price per net mineral acre, they're having a certain fixed amount of costs that bake into any offer and into any valuation because it's the same amount of work at the end of the day to do the legwork and the due diligence on those two transactions. Is just spread out more over 100 mineral acres versus 10. So those are the things to think about from your options. Again, what you're going to sell and then how you go about selling it.
Absolutely. And then the last step is to have a plan, which is critically important. How does selling minerals fit into your overall financial plans? Like Matt mentioned, it's going to be different for every single person. And having advisors on the tax side and the attorney side are great things to have there. What are the tax implications of selling some or all of your minerals today versus waiting till next year to do so? Do you want to reinvest to another asset class? If that's the case, a 1031 exchange may make sense. Which, Matt, what episode was that 1031 exchange that we did?
So that was episode 54, where we talk about using a 1031 exchange to defer capital gains tax. So to find out more about 1031 exchange, check out that episode and then when it might make sense if you're selling your minerals. And this is something to definitely do in advance. So there's some specific timelines associated with 1031 exchanges that you need to be aware of if that's the route you're going to go.
And then estate planning. Anything that's divested needs to be updated in the estate plans, and any changes that are made to the property ownership needs to be updated. So, Matt, you want to run us down a summary of all that?
Sure thing. And just to recap, episode 54 about 1031 exchanges, and then also episode 67, which we had just a couple of weeks ago. We spoke with Ben Kinney with Kinney Law Office about estate planning, and definitely a big event like selling some or all of your minerals would be a good time to update your estate plans to reflect that. In summary, again, the 5 key steps in the roadmap if you're thinking about selling your minerals. Number 1 is to know what you own. Number 2 is to know what your property is worth. So this is where you can hire a consultant to do a valuation for you to help to understand the assumptions that go into that, which would include number 3, which is know what is going on. And so that would be doing the due diligence as to nearby permits, nearby drilling activity, what the operator that has your lease is doing, and what their capital expenditure plans are for the next year or two to inform the timing of when wells might be drilled. And so that can be something you can do on your own through free websites like Well Database, or again through the state oil and gas commission as well. Step number 4 is to understand your options. And there are pros and cons of the various options, like we mentioned, whether it's selling some or all of your mineral interest, selling a non participating royalty interest, selling a wellbore only interest, and all the flavors in between. Understand your options and understand how much you want to raise and then how those options might fit into that. And then 5 is to have a plan. And again, this is tying the sale of your property into your overall financial plans. And so getting with a financial advisor, getting with an estate planning attorney, updating any plans to reflect that. And just before we close out, Justin, let's talk about some of the pros and cons of selling in 2020, because I know that's something that is probably on a lot of people's minds with everything going on right now. Is it a good time? Is it a bad time? It's a lot of questions being asked.
Absolutely. And one of the ones, if Biden gets elected and a fracking ban is passed, even if only on federal lands, it could redirect some of the investment to fee and mineral acreage and accelerate development, assuming commodity prices continue to stabilize around the $50 a barrel for oil and 2.5 MCF for gas. If fracking ban extends beyond federal acreage, it could result in a significant devaluation of any fee minerals since no activity is likely in the next 4 years. What's your thoughts on that, Matt?
Yeah, I think you hit the nail on the head there. I think it's definitely something where it seems at face value a fracking ban on federal acreage could be bad. And I think in general, anytime the government gets involved to impose these artificial regulations or requirements on the free market, it just ends up backfiring. So I think it does. And personally speaking, my opinion, I think it's a bad idea. But if that happens, the one silver lining to that could be if oil prices do stabilize, because we're going to have no more drilling on federal lands, well, that would mean a decline in production should help with supply and demand balancing out, and prices could go up. If that happens and companies are beginning to reinvest in drilling new wells, they're going to be looking at private land or that fee acreage. And so that's us. That's the mineral owners that own property in these different basins, and it could mean that these companies are going to spend more money drilling these unconventional wells in these shale basins because they can't go and drill and get an offshore lease or a permit on federal lands, and so they have to refocus that money that they're reinvesting in their business onto fee acreage. So if that is the case, then it could accelerate the timing of when some of these wells come online, which again, like we've talked about earlier, timing is everything from a value point of view. So if there are concrete plans that a company is going to drill a well next year versus 3, 4 years from now, then it would mean more money in your pocket. So that, I guess, could be the silver lining. But again, in principle, I think it's a bad idea.
Yeah, I happen to agree. And capital gains tax rate, it's pretty good right now, Matt. You want to talk a little about that?
Yeah, I mean, it's probably as low as it's going to be for the foreseeable future. With all of the money that the government is printing with the stimulus packages, with the coronavirus kind of economic impacts, I think what we're going to probably see in the future is an increase in tax rates because they've got to somehow pay for all of this. And so it's very likely that the capital gains tax rate is going to be as low as we're going to see for a while. And so if especially if Biden gets elected, and historically Democrats have been inclined to raise taxes, although that could happen, I suppose, with any administration given the fundamental elements of what's going on. But more likely, I think, with a Democratic president and a democratically controlled Congress and Senate. So if that is the way things shake out after the election, then selling in the future could mean that you have a higher tax liability, and if that capital gains rate is increased. And so for the same dollar that you would receive long-term capital gains tax rate in 2020, again, get with your tax advisor. We're not providing tax advice, but depending on your tax bracket, it could be 15% or 20%, depending on your, again, taxable income, marital status, all that good stuff. If you're faced with a tax rate of that versus if it goes up something higher, then that's just more money taken out of the net amount that you receive from that sale. So that's something that consider. Capital gains and taxes are definitely an impact, especially if you have a significant size property that could be worth multiple 6 or 7 figures.
Absolutely. And again, that 1031 exchange episode is something to check on if that's a situation that you're going to find yourself in. So a con we have is we're in a low period, but general consensus among mineral buyers is that now is a good buying opportunity. And they expect commodity prices to recover over the next few years and activity to pick back up in the core acreage of major shale basins. If you sell now, you might be missing out on future potential of any new wells being drilled and future royalties, which I certainly agree with that, and be interesting to see what ends up happening in the market. Nobody knows for sure.
Nobody knows, but yeah, it's something to think about. So obviously, you sell it, you don't have the benefit of that future upside going forward. So you have to think about that, and it's a big decision. So in conclusion, here we'll just kind of wrap it up with, really just depends on your personal situation, like Justin mentioned at the beginning. Selling your minerals can be a final decision, or it can be a matter of selling part of your interest or selling just the wellbore only, or just on an interest in those producing wells. So it's a big decision either way. You need to factor in how that will affect your overall financial and tax situation. So consider talking with a financial advisor. I know how this might fit into those plans again beforehand. Consult with your tax advisor to understand the tax implications before you sell. Another thing you have to think about is figure out what your tax liability is from the sale. And so your tax advisor can help you walk through that. If you don't have a step up in cost basis already established, you may need to have a retrospective valuation performed so that you could figure out what the property value was when you inherited those minerals, as an example, if you inherited them a few years ago. And because if you have a zero cost basis, that's going to be more tax liability versus if it had some value when you received it. So that's something that you'd have to think about. You want to consult again with an attorney to update your estate plans if you decide to sell some or all. And then also to have that attorney review any paperwork that you sign. So that's where you'd want to have somebody looking over your shoulder, making sure that you know what you're signing before you sign on the dotted line of any purchase and sale agreement or any sort of deed or conveyance document, because the wording in those documents will dictate what rights you have, what rights you're giving up. And so it's really important that you understand that before you sign. And then if you want to negotiate this on your own, again, we've talked about the turnkey option of hiring an advisor to help you through the process and to do that on your behalf and solicit multiple bids. And then you just have to sit back and review those bids and then make a decision as to who you want to sell to and what the terms are and what you're comfortable with. But if you're going to do it by yourself, if you go the DIY route, then if you don't have a lot of negotiation experience from your job, then do some research and do some practice as to negotiating. So that could be researching some negotiation tips. There's a really good book by Chris Voss, who is a former FBI hostage negotiator. So the title of the book is Never Split the Difference. I'll link to the book in the show notes so you can take a look at that. But I would highly recommend buying that book and reading it if you just do decide to go it alone and negotiate on your own. And then again, it's one of those things where you'd want to get multiple bids, get multiple offers, do the due diligence on who's the reputable end buyers in your area where you own minerals, and negotiate with multiple buyers so that you can play them off each other and get the best value at the end of the day. Those are a few tips as we wrap this up. But again, this is a big decision, something you need to think about how it fits into your overall goals. We're not advocating that you should sell or not sell, but just something that if you are faced with this decision, we wanted to provide the information and the roadmap so that you would know all the steps that are required in order to make that an informed decision so that you don't get taken advantage of. So I hope this has been helpful. If it has, greatly appreciate a review on Apple Podcasts or wherever you're listening to this. Just 1 minute and hopefully a 5-star rating. If not, send me an email at feedback@mineralrightspodcast.com to let us know how we can get better. Thanks again, Justin. Appreciate your time.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.